Welcome to Books in Sum, your go-to for bite-sized book summaries.
Big Mistakes by Michael Batnick. A select group of investors are led through their worst investments by Michael Batnick. He demonstrates how one can gain access to the experience and insight of the most successful people in a field without incurring the same level of financial risk. Value investing was popularized by Benjamin Graham, who observed that stock prices tend to fluctuate more than their intrinsic worth. Since prices are determined by individuals while values are determined by businesses, and since individuals tend to be more impulsive and emotional than businesses, there is a wide range of variation in both. In the 1930s, for instance, investor sentiment shifted from bullish to bearish, causing General Electric's market cap to fall from $1.87 billion to $784 million. During the Great Depression, Benjamin Graham was nearly bankrupted by his conviction that price and value were out of whack in the 1920s. He made a risky wager that prices would decline, but his prediction was too conservative. Graham resumed his heavy investment in the stock market in 1930, when the market had already taken a severe beating, but he watched as prices continued to fall until the market finally bottomed out in 1932. Jesse Livermore made $50,000 in his first week as a stockbroker after moving from Massachusetts to New York in 1877. He went short on 2,000 shares of U.S. stock in 1901, steel, and a potentially risky 1,000 shares of Santa Fe Railroad stock. His entire life savings of about $50,000 was lost between the two deals. The 1929 crash provided the ideal conditions for short selling, which suited the naturally skeptical Livermore after he had paid off his debt and returned to New York to resume speculating. He amassed a fortune that, in today's dollars, is worth $1.4 billion very quickly. When the stock market bottomed out in 1932, Jesse Livermore was among the world's wealthiest people. He risked his savings and ultimately failed. He spent the next few years trying to make ends meet before taking his own life on November 29, 1940. Many people looked to Jesse Livermore for financial advice, but he went bankrupt several times because he couldn't control his risk. Sequoia Fund should have paid more attention to diversification, the most effective method for mitigating risk. The fund recommended an unwise investment in shares of Valent Pharmaceuticals to its investors in 2010. The share price of the company increased by 70% by the end of the year, and the following year was just as fruitful. Valent, on the other hand, underinvested in research and development in favor of buying up existing drugs and charging exorbitant prices. Sequoia's fortunes plummeted after Valent's 2013 acquisition of Medicis, which had developed a remedy for lead poisoning. In just a few months, the company saw its asset value drop from $9 billion to below $5 billion. American literature lost a great writer in Mark Twain because he put emotion over reason. He had a special fascination with inventors and their creations and was always on the lookout for the next big thing that would change the world. He put $42,000 into a K-latte, an innovative new technological process, but it failed to deliver, and Snyder turned out to be dishonest. The greatest mistake Twain ever made was saving money and not investing in a telephone. General Joseph Roswell, a friend of his, had recommended that he check out a presentation by a young inventor named Alexander Graham Bell. Before he turned 30, Jerry Twain managed the Fidelity Capital Fund, making him the first celebrity fund manager in the 1960s. He made a lot of quick trades that were often impulsive but perfectly timed, as part of his aggressive investment strategy. Twain gave Fidelity annual gains of 296% from 1958 to 1965. He left Fidelity in 1965, at the height of his fame, to found the Manhattan Fund. Demand for the Manhattan Fund's stock offering of 2.5 million shares was 10 times higher than anticipated, and the fund had to cancel the sale. IBM and Xerox respectively grew by 88% and 171% between 1964 and 1968, a time of tremendous economic expansion. Cy was part of the first generation of investors to grow up in an era of unprecedented prosperity. Cy's ego was inflated by the exponential growth of the stock market in the 1960s. The price drop of 1,969,197, however, was approaching quickly, and he was unprepared for it. Investors fled in droves as they realized that Cy's machine gun approach to investing was not well suited to recessions and their aftermath. Billions of dollars have been lost by even the most successful investors due to overconfidence. Warren Buffett, arguably the most well-known investor ever, has an impressive record of success. The Oracle of Omaha oversaw a partnership that saw returns of 2,610% between 1957 and 1969. Since Buffett and Berkshire Hathaway bought See's Candies for $30 million in 1972, the company has made $1.9 billion before taxes. By 1993, Buffett's list of accomplishments was long. The $433 million purchase of the Dexter Shoe Company was Berkshire Hathaway's biggest blunder. He was so taken with the acquisition that he failed to notice the shifts in the market. 5 years later, with the rise of manufacturing powerhouses like China and Taiwan, Dexter was in freefall. Due to his recent string of successful business transactions, Buffett became complacent. Like in chess, it's crucial to minimize careless mistakes if you want to succeed as an investor. Although professionals rarely lose points due to unforced errors, this should be a primary concern for beginners. For instance, in 1999, Stanley Druckenmiller made a series of mistakes when he risked $200 million of Quantum's capital on a price decline. He was so confident in his prediction that he risked $200 million of Quantum's money on a price drop that never came to pass. Instead of frantically searching for small victories, readers should focus on eliminating the many examples of unforced errors presented here. As opposed to searching aimlessly for big wins, investors should concentrate on eliminating unnecessary losses. Druckenmiller gave an example of the peril of careless mistakes and why we should work to eliminate them rather than searching aimlessly for triumph. Charlie Munger, vice chairman of Berkshire Hathaway and longtime business partner of Warren Buffett, is known for his formidable intellect and knack for turning questions on their heads and deconstructing complex problems. He put 61% of his portfolio into blue-chip stamps, which made loyalty tokens redeemable for consumer goods. The company was hit hard by the subsequent economic downturn because of its reliance on the consumer market. These instances highlight the significance of accepting devastating setbacks in stride and eradicating them entirely rather than frantically searching for a silver lining. Although Charlie Munger's January 1973 blue-chip investment nearly bankrupted him, he eventually came back even stronger. By December 1975, his investment firm had gained 73.2%, and Blue Chip had acquired several companies that would eventually become Berkshire's crown jewels. After a rough patch in the mid-1970s, Munger is now a pillar of strength at one of the most prosperous investment firms in history. Investing is risky, but by learning from the mistakes of the greats, we can reap the rewards without spending millions of dollars. Take this piece of advice to heart and do not overtrade. According to Warren Buffett, investors should proceed with caution and only make high-quality trades if they believe they have only 20 opportunities in their entire career.
We hope you found this summary helpful in your listening journey. If you're interested in diving deeper into the topic or getting your hands on the whole book, be sure to check the description below where we've included links to the book and other related products that may be useful to you. Don't forget to hit that subscribe button to stay updated on our latest book summaries. And feel free to leave a comment with any suggestions or requests for books you'd like us to cover. Thanks again for tuning in and happy listening.